friends, welcome to our channel Accounts and Finance with FARSK. This is our video on the third part on the series on the financial accounting ratios, liquidity ratio. Hope you will like, share and subscribe our channel. Liquidity ratio. The 5 standard financial accounting ratios: liquidity, profitability, solvency, turnover, and earnings ratio. Introduction. Liquidity is the lifeblood of a business. If a company doesn't have enough liquid assets, that's things it can convert to cash quickly, like marketable securities, accounts receivable, and inventory, to meet its current period financial obligations, it might need to declare bankruptcy. Liquidity ratios provides a sense of a company's financial health. It determines how quickly a company can convert the assets to cash and use them for meeting the dues that arise. Apart from its ability to turn assets into cash to pay for liabilities, also means a company's debt capacity. Refers to a company's financial position of being able to service the current debt or have to raise funds through any external debt. Generally, the meaning of liquidity as per financial accounting term means what are the liquid assets the company has. In other words, liquidity ratios are a financial parameter to measure a company's ability to meet its short-term or current liabilities, that is, those due within the current period. Solvency measures a company's ability to meet its financial obligations over the long term. Liquidity should be quick and cost-effective. Liquidity ratios are quite effective in comparative form. The analysis of these ratios can be internal or external. For instance, the internal analysis of liquidity ratio engages multiple accounting periods reported through the same methods. Comparison of previous periods and current operations can help analyze and track any changes in the business. Liquidity answers the questions as follows. Is there enough cash to meet payment obligations in the short term? Do you want to do business with a company? Note: liquidity ratio measures the company's ability to pay short-term debt or current liability, whereas solvency ratio measures the company's ability to pay long-term debt or non-current liabilities. The types for liquidity ratio: current ratio or net working capital, quick ratio or acid test ratio, operating cash flow ratio. Current ratio, also known as net working capital ratio, evaluates a company's capacity to settle its short-term debts with its current assets. Current assets include things like cash and cash equivalents, marketable securities, accounts receivables, and inventories that can be turned into cash within a current period. Liabilities with a 1-year maturity date, such as accounts payable, short-term loans, and taxes payable, are categorized as short-term obligations. Indicates the ability of an entity to clear its current liabilities immediately by monetizing its near-term, more liquid assets. Current ratio reflects the short-term liquidity position of the entity. That is, it indicates whether the short-term or current assets owned by an entity are sufficient to meet its short-term obligations. Formula: current assets by current liabilities. Ideal ratio: minimum must be or should be 1.2:1. Quick ratio, also known as acid test ratio, is considered a more rigorous solvency test but accurate portrayal of this ratio than the current ratio because it indicates the company's capacity to clear its current dues in a relatively shorter period. Quick ratio measures the ability of a company and indicates to use its near cash or quick assets or highly liquid assets to meet its current liabilities immediately without using inventories and prepaid expenses. The metric calculates the ability of a company to repay its short-term debt with cash or near cash resources, such as securities which are easily marketable. Formula: current assets minus inventories divided by current liabilities, or cash and cash equivalents plus short-term debtors plus ready marketable securities divided by current liabilities. Ideal quick ratio: 1:1. If it is more than 1, it means the entity would still have some current assets other than inventories left even after the payment of all current obligations and the desirable position every entity would like to be in. Operating cash flow ratio. This ratio measures a company's ability to generate cash flow from operations to meet its short-term obligations. A higher operating cash flow indicates better financial health and a lower risk of default. Also measures the number of times the company can pay short-term debts or current liabilities with the cash generated during the same period. Formula: operating cash flow or cash flow from operations divided by current liabilities. Ideal operating ratio: over 1 is desirable. Conclusion: overall, a liquidity ratio of 1 or more suggests that a company has more than enough liquid assets to cover its current liabilities. Ideal liquidity ratio: 2:1. That's it for today. Hope you like our video. For more videos, please do not forget to like, share and subscribe our channel. Accounts and Finance with FARSK. Thank you. Have a great day.